Hi there, Catherine Tindall here. This is the follow-up video for you all of the Q&A that was submitted during our Friday session. So I'm going to just try to go through these quickly. I put them in order of what I think was going to impact the most people first, but we will talk through these. So let's get started. 941s filed by a payroll processing company. Do they have to do the 941X? The answer is no. If they typically, the CPA firm or whoever's doing the calculations will be recalculating and preparing the 941X, and then usually those are provided to the payroll company after the fact. But unless it's a PEO where everything was filed under their EIN, typically no, it'll just be the person that's doing the preparation. Second question, if someone buys an existing business or a portion of an existing business, would they qualify as a recovery startup business? And they indicated that it's not a stock purchase. Very likely, yes. The thing you would have to watch out for is if a potential aggregation issue is in place, if the person who purchased the portion of the business has other business interests that were operating pre-pandemic, very likely those would need to be aggregated. Next question. Private equity company owns 60% of our company. Hence, we did not qualify for PPP. Would we still be eligible for the ERC? Similar issue. You're very likely going to have to aggregate with the PE company. So it would just come down to whether the PE company and any other aggregated entities are qualifying as a whole. So potentially yes, just depends on the size there. Next question, is a government order a must to claim the credit under nominal effect? Do you have to attach it to the filing? No. Is the IRS going to ask for it under audit and requires it as a substantiating document? Yes. So you definitely want to have that in hand before you do any submission of ERC. Next question, is there a one-stop shop online to search orders? The answer is no. What we use and what I can recommend if you're going to be doing a lot of this, or this is a significant area of interest for you, is that LexisNexis has a product with StateNet that is a good database, but it's not comprehensive. Very often it's a bit of a wild goose chase to get the orders. So the answer is no there. Next question, can you clarify if employers with between 100 to 499 FTEs in 2019, eligible wages are calculated differently than for small employers? Basically for large employers, so if you had over 100 FTEs, you basically only will get the credit for wages that were paid to have employees stay home and not provide services. But typically, like in the presentation I mentioned, you want to basically, if you have a large headcount of employees, whether or not you think you qualify for this credit, you should just have a formal assessment done because of the sheer, dollars on the table of a potential eligibility question. And there's a lot of complexity around FTE calculations, et cetera. So I would just recommend you have an assessment done. But basically, the big change is you just had to pay people to stay home. I have a client with 4 employees. Do they have enough employees to qualify for this program? The answer is yes. There's no minimum number of employees to qualify for the program. The real question is it practical? Because given the relative credit amounts, you still have to file amended income tax returns and amended payroll tax returns. And so it's a cost-benefit analysis question. But you could have a part-time employee and still qualify for the credit. So it's not a limited number like that. Next question. Are government organizations eligible for the ERC? The answer is in there. If you want to look at this, IRS Notice 21-20 question 2 addresses this. The answer is no. And then there's a list of what's considered a government organization. So no. Which tax year does the ERC expire? So for 2020 claims, the expiration window is starting April 15th, 2024. That's when 2020 will expire, the whole year. And then for 2021 claims, the ERC expires in April 15th, 2025. So we actually have quite a bit of time left for the program. What are your fees? So for us, we're a CPA firm. We do not charge a contingent percentage. It depends on the scope of the claim, the project, the quality of the data, et cetera. We do have a case minimum of $7,000. And that's, the percent, giving a rough ballpark of what we charge fee-wise
It really depends on the size of the claim, but for your typical small to medium-sized claim, we come in between 10 to 15% of the credit, just as an average range, just to give you a sense. How does Dominion engage with tax pro clients? So basically, we work with outside tax professionals to sort of be their ERC department. It depends on the level of participation that they want to have with us in the process. But if you're interested in that kind of arrangement, there'll be a link below for how to get in touch with me, and we can have a conversation about what that would look like. Next question. Does a customer imposed restriction qualify if having over a 10% impact on the business? Large painting contract limited employees. So basically, the question here was, if a customer was imposing a restriction, does it qualify? Only if the restriction is actually originally coming from a government order will it qualify. So very often with especially in the construction industry, there could be client imposed restrictions, but if it's purely just coming from a customer, then no. But if the reason why the customer is now putting it on you and that really you're subject to it too is a government order, then yes. But if it's purely customer, then no. Next question. 50-50% ownership with spouses. Is it correct that stepchildren do count and they are not excluded? Do related party employee wages count towards ERC calculations? So when people fall into the bucket of being a related party, so you have an over 50% ownership share, that's when they're not going to count. And how do you get to that? Are they over 50%? Is you look at the whole group of owners, and if there are any family relationships with any of the owners, you have to add their interests together. So when you have spouses, they have to be added together. So the fact that they're 50-50, the IRS says, well, in reality, you're 100-100 because you have mutual control. So the question with the stepchildren, the answer would be, they're still going to be children of one of the spouses, so they would have to be excluded, and basically any wages related to related parties, so those owners, and then any family members that are paid in the business, so if children, non-owner siblings, those types of people, they're not going to count. The full list, if you look in the presentation slides, is available from the IRS of who counts as a related party and who doesn't for relationships, but we're looking for that over 50% threshold, and then it kicks in. Next question. Are owners of sole proprietor businesses who issue W-2 to only themselves and family member workers eligible based solely on W-2s? You can have an eligible window, but you will not have any eligible wages, because if it's a majority ownership and everybody's family members, then none of the wages will qualify. Will there be interest and penalties on amending the returns? The answer is yes. But because the IRS pays interest on the credit itself, those tend to net out, because you're getting charged an interest and penalty rate on a loss of a deduction, which is a fraction of the credit, and the credit itself is getting a percentage of interest paid to it. So it usually ends up netting, and it doesn't actually negatively benefit the client usually. Would a nonprofit need to amend their 990? I would consult with your tax professional for that. If you have unrelated business income, so wages related to activities that are subject to income tax, then yes. If not, and it's totally exempt income, I would consult with your tax pro whether or not you're going to need to do that. Very often the answer is no. You can just do it as a prior period adjustment, but talk to a tax pro about that. If a company qualifies for the credit in the third quarter of 21, does it automatically qualify for the fourth quarter too? The answer is no, because the program closed Q4 of 2021. So unless you're a recovery startup business, which I didn't discuss that too much, you're not going to qualify for the fourth quarter. If a corporation first started paying wages in 2021, can they still qualify since there'll be no reduction compared to 2019 or 2020? So the testing is done with revenues, not wages. So if you have an organization that wasn't paying any wages in 2019, but the revenues dipped appropriately in 20 and 21, and then they started paying wages in 2021, then yes, they would, they could potentially qualify. So there's that. Next one. I work for a biotech R&D where there's no gross receipts income, so I can't show a decline. Can my entity qualify? The answer is yes. Under the non-revenue testing, it just depends on whether you can find the government orders and then substantiate the 10% impact. Typically for biotech, it can be tough because if you're able to effectively work remotely, then that having to transition to a remote environment, even though it was caused by a government order, doesn't qualify. That's something that's mentioned on the operation questionnaire in the presentation if you're interested in more information on that. Aren't you concerned that IRS can dispute any argument, especially if the company did well with hindsight? So this is a complex question. I would say, technically the IRS can dispute anything, right? It depends on the education level of the agent that you're dealing with. And with this program, just a little bit of experience is that, there's varying levels of tax knowledge with IRS agents. But basically, if you're following the rules of you have that government order and you can show quantitatively that 10% impact, that's what the law is. And so whether or not the company performed better or worse, et cetera, it's a moot point because the way that the rules are written is the government order and then the substantiating more than 10% impact. So as long as you have those, I don't think the IRS has any ground to give you trouble on, if revenues went up, because another division of the company started to do better. It's really not how the test is written. You just need to show the restriction was causing that 10% impact. What percentage of submissions do you expect will be audited by the IRS? I don't have an answer on this because I don't have an insight into the level of negligent claims that are going on in this program, though just based on the amount of sheer advertising and things that I see, I think it will be very high. So that's why I just tell people, assume you're going to get audited and make sure all your I's are dotted and your T's are crossed, and then you have nothing to worry about. Because, they've said in the past that they're reallocating 80% of examination personnel to this program. But I think even with that, just the sheer level of bad claims being filed is going to keep them pretty busy. A few more questions here. Tax credit is filed on the year it is earned, but what about the interest on the refund? Does it go to the same year on the 2023 return since that's when they receive the interest? Depends if they're a cash or accrual-based taxpayer, but typically for the cash basis taxpayer, the interest portion of it will just be picked up on 2023 when the interest is actually received. Taxpayer has an LLC and received ERC funds for 2020 and 2021. He reported the net income loss from the LLC under Schedule C. Does the taxpayer need to amend the personal tax returns for 20 and 21? If he received the funds, if he received the credit from tax years 20 and 21 and received the funds later on, he still has to go back and amend the 20 and 21 returns. And that's based under that matching principle code section from the IRS. So even though he's a cash basis taxpayer, I assume you still have to go back and amend those returns. What wages would be available to file for the ERC if wages have been used for the PPP loan? So just to explain this a little bit, typically you'll have your ERC eligibility window within a period that PPP is happening as well. And basically, if you have an overlap in your PPP forgiveness application, your covered period, so say it's, part of Q2 2020 and Q2 2020 is qualifying for ERC, the wage base that was used for the PPP forgiveness is not going to be eligible for the ERC. Now, for the most part, most businesses paid more wages within that covered period for a PPP than the amount that they needed to use for forgiveness. So say, your average, I'm just going to make up an example. The company had a wage base of, they paid $200,000 during Q2 20, but they only got a PPP loan of $130,000. So you've got a $70,000 chunk that wasn't applied towards PPP that if you're eligible for ERC in Q2 of 20 is available towards that ERC calculation because that 130 that was subject to the PPP has been eaten up. But then you've got that 70 left over. And then, the 130 plus 70 equals the 200 total wages that you paid. So that's kind of the basic mechanism of it. And then you would just need to do the allocations based on the pay dates, as well as any related parties who don't qualify for ERC anyway, but those related parties very likely did qualify for PPP. So you have to kind of work through all of that allocation. But that's why typically I said,
90% of the cases that I work on have both. PPP does interact. Does it wipe out all the ERC? Usually not. There's usually some left over. So that's why it's good to, have somebody actually do the allocation and see what it is. So those were all of the questions for the Q&A for me to answer for you today. If you have any additional questions, please feel welcome to submit them to the admin team. And if you are a tax pro or an organization interested in getting in touch with us, learning more about our process, or having a formal assessment done, please feel welcome to reach out. You can visit our website, and there's links there to get in touch, and there'll be links surrounding the mechanism by which I'm sharing this that you can get in touch with us to have an individual assessment done. Because really, until you have somebody look at the idiosyncratic data for your company, it's really hard to tell a lot of the time whether or not you're going to be eligible and what that process is going to look like. So I encourage you to reach out if that's something you're interested in. So thank you again for attending the webinar on Friday. I hope these Q&As were valuable for you. And we'll also be following up with some additional tools and resources for you, but feel welcome to reach out if there's anything that the DES team can help you with. Thanks, and have a great rest of your day.